Hello friends. Balance sheet or statement of financial position as per IFRS is very different from the usual balance sheet that we come across. So in today's video, let's look at what makes up a balance sheet as per IFRS. My name is Pratij and welcome to Deep Dive into IFRS. So I'll list out the minimum line items to be shown in a balance sheet as per IFRS. Along with the line items, I'll also tell you the governing standard that deals with them. So the following are the minimum line items to be presented in a balance sheet as per IFRS 5. Property, plant and equipment as per IAS 16. Investment property as per IAS 40. Intangible assets as per IAS 38, financial assets excluding investments accounted for under equity method, trade and other receivables and cash equivalents as per IFRS 7 and IFRS 9, investments accounted for under equity method as per IFRS 9, inventories as per IAS 2, biological assets as per IAS 41, trade and other receivables as per IFRS 9, cash equivalents as per IAS 7 and IFRS 9, total assets classified as held for sale and assets included in disposal groups classified as held for sale in accordance with IFRS 5, trade and other payables as per IFRS 7 and IFRS 9, provisions as per IAS 37, financial liabilities excluding provisions and trade and other payables, deferred tax assets and liabilities as per IAS 12, current tax assets and liabilities as per IAS 12, liabilities included in disposal groups classified as held for sale in accordance with IFRS 5, non-controlling interest as per IFRS 3 and IFRS 10, and finally capital and reserves as per IAS 32. Now the above presentation of minimum line items is as per Indian accounting standards. As per IFRS, there are two more items to be shown: insurance and reinsurance contracts that are assets as per IFRS 17 and insurance and reinsurance contracts that are liabilities as per IFRS 17. So as I already mentioned, the above are the minimum line items that are to be given in a balance sheet. If as an accountant or as an auditor you feel that some extra information or some extra line items can improve the readability and understandability of a financial statement, you can present those line items as well along with the subtotals. And all the above items have to be presented as current assets, non-current assets, and current liabilities and non-current liabilities. There is only one exception to this condition. When you feel that presentation based on liquidity is more reliable and more relevant, that is allowed. In that case, this non-current and current classification is not required. Now, as per IAS 1, an entity having clear operating cycle should always present the items as current and non-current. But if you see some financial institutions like banks and insurance companies, they don't have a clear operating cycle. And for that reason, they follow a different type of reporting, which gives a reliable and more relevant information. Now, what is clear operating cycle? That will be defined or explained in a different video in future so that the concept is clearer to you at that point in time. But irrespective of what kind of reporting you are following, with respect to payables and receivables, you always have to give the following bifurcation. That is, the payables and receivables expected to be settled or recovered within a period of 12 months from the end of the reporting period, and payables and receivables expected to be settled or recovered after a period of 12 months from the end of the reporting period. But please note that the current and non-current classification as per IFRS is not the classification that you're used to. That is, the within 12 months it is current, if it's after 12 months it is not current. That is not the case with respect to IFRS. The classification and definition of non-current and current assets and non-current and current liabilities will be explained in the next video. Till such time, thank you for the valuable time and I hope this video was useful to you guys.